Right now, something massive is unfolding in the silver market. And it is not just another short-term price movement or temporary volatility spike. It feels like one of those rare moments where multiple forces are colliding at the same time, creating a situation that could reshape how investors understand silver itself. The energy around the market has changed, and many traders are starting to realize that this is not simply about price charts or daily candles, but about structural shifts happening beneath the surface. What makes this moment so unusual is the combination of extreme trading positions, regulatory intervention, tightening physical supply, and rising global uncertainty, all occurring simultaneously, creating a perfect storm that demands attention. For years, silver has often been overlooked compared to gold or cryptocurrencies, but suddenly the metal is back at the center of financial discussions, and the tone surrounding it has shifted from quiet accumulation to explosive unpredictability. Large institutional players, aggressive speculative trades, and sudden regulatory actions have turned silver into one of the most closely watched assets in the market right now. The magnitude of recent events has shocked even experienced investors because scenarios that were once considered theoretical are now playing out in real time, revealing how fragile and interconnected the modern futures market can be. This is why many analysts are describing the current situation as unprecedented, not because silver has never been volatile before, but because the scale and complexity of what is happening now goes far beyond normal market behavior. At the same time, broader economic pressures are amplifying the importance of precious metals. Concerns about inflation, geopolitical tensions, shifting global alliances, and the growing demand for industrial metals are pushing investors to reconsider traditional safe haven assets. Silver sites at the intersection of both industrial necessity and financial protection, making it uniquely sensitive to macroeconomic changes. When markets become uncertain, silver often reacts dramatically, and that is exactly what we are witnessing now. A surge of attention fueled by fear, opportunity, and speculation. What makes this moment truly monumental is that it may represent a turning point, where silver transitions from being seen as a secondary metal to becoming a primary focus of global financial strategy. Investors are watching closely because the moves happening today could set the tone for years to come, and the implications may reach far beyond the silver market itself, influencing commodities, currencies, and even broader investment psychology. A reverse Hunt brothers situation is emerging. What we are witnessing right now feels eerily familiar to one of the most famous moments in silver market history, but with a shocking twist. Because while the Hunt brothers in 1980 tried to corner the market by aggressively buying silver and driving prices higher through leverage, today the market is facing a reverse scenario where a single trader has built an enormous short position, betting against silver on a scale rarely seen before. This reversal fundamentally changes market psychology, as instead of upward pressure from aggressive buying, silver is now under downward pressure created by an oversized short strategy, amplified by massive leverage that allows one participant to influence sentiment far beyond normal limits and raises serious concerns about stability, liquidity, and the imbalance between paper contracts and physical supply. What makes this situation especially revealing is how it exposes the structural tension between futures markets and real metal, since futures allow control of vast quantities of silver without owning it, creating a paper supply that can dwarf actual inventories and turning this trade into a high-stakes gamble that risks cascading sell-offs and intensified bearish momentum while drawing inevitable regulatory scrutiny. As the situation escalated, regulators stepped in decisively, with the Shanghai Futures Exchange freezing the trader's account and locking the massive short position in place, a rare and serious intervention that signals potential systemic risk and dramatically increases uncertainty by removing the trader's ability to adjust or hedge. This intervention has sent shockwaves through the market, reminding participants that when leverage becomes extreme and concentration grows too large, exchanges will act. And history shows that when such positions unwind, market reactions can be sudden, violent, and far-reaching. Short position, bigger than physical supply. One of the most shocking elements of this story is not just the existence of a massive short position, but the sheer scale of that position relative to the physical silver available on the exchange, as the short exposure at one point exceeded the total silver held in vaults, turning what was once considered a theoretical risk into a real and deeply unsettling reality that challenges liquidity, risk management, and the integrity of price discovery. Futures markets rely on leverage and the assumption that positions remain reasonable compared to available supply, but when that balance breaks, volatility surges and confidence erodes, especially as reports of shrinking inventories and silver leaving vaults made the oversized short position appear increasingly dangerous rather than calculated. As physical supply tightened, the situation evolved into a direct confrontation between leverage and scarcity, raising the risk of a short squeeze in which rising prices could force the short seller to cover, accelerating upward momentum and intensifying pressure as the market senses vulnerability. Each withdrawal from exchange vaults effectively increased the relative size of the short exposure, magnifying both financial risk and psychological tension, and turning inventory data into a critical signal watched closely by traders and analysts alike. Beyond short-term price action, this episode exposes a deeper structural weakness in modern commodity markets, highlighting how the growing gap between paper contracts and physical assets can push systems toward instability when concentrated positions grow too large, transforming an ordinary trade into a potentially historic moment for the silver market. Regulators send a strong warning to the market. This type of regulatory action serves multiple purposes, stabilizing the immediate situation while also acting as a psychological reset that forces traders to reassess risk, discourages aggressive speculation through fear of scrutiny, and shifts the narrative from hidden leverage to public accountability. Transparency itself becomes a tool of control, because by allowing details of the position to reach the public, regulators placed pressure not only on one trader, but also on institutions using similar strategies, reinforcing that exchanges actively monitor systemic risk and are willing to step in to protect the broader financial system. The timing of the intervention also appears designed to preserve confidence in the exchange, as decisive action reassures participants that pricing remains fair, liquidity is real, and no single entity can dominate the market to a destabilizing degree, ultimately turning the episode into a cautionary example of how leverage, power, and oversight intersect in modern commodity markets. Flash crash and massive profit. As the market absorbed the shock of the massive short position, silver experienced a sudden and dramatic price drop that many described as a flash crash, with prices falling sharply in a very short time due to high leverage, automated trading, panic-driven reactions, and the influence of an oversized short position, revealing how fragile market stability can become when concentrated bets meet thin liquidity. During this rapid downturn, reports suggested the trader behind the massive short generated extraordinary profits, potentially reaching hundreds of millions of dollars, highlighting the powerful incentives of leverage strategies while raising serious questions about whether the flash crash was a natural reaction or partly driven by the sheer size of the position itself. The situation grew more complex after the account freeze, as uncertainty emerged over whether regulators would allow profits to be withdrawn, since authorities may investigate potential manipulation or rule violations, turning what appeared to be a trading success into a legal and financial dilemma. Beyond the individual trader, the flash crash reminded investors how quickly sentiment can shift when extreme positions unwind or become public, forcing reassessments of risk, liquidity, and strategy, and creating a high-stakes narrative where the final outcome remains uncertain. Despite the chaos and regulatory drama, many analysts remain strongly bullish on silver's long-term outlook, arguing that beneath short-term volatility lies a deeper structural story driven by supply and demand fundamentals, and silver's dual role as both a precious metal and a critical industrial component. One of the most important demand drivers is the rapidly expanding solar energy industry, where silver is essential for photovoltaic technology, creating steady and growing physical demand as global renewable energy production scales. Beyond solar, the electronics sector continues to reinforce silver's importance as it is widely used in semiconductors, electric vehicles, medical devices, and advanced manufacturing, supporting long-term demand through technological expansion. At the same time, silver benefits from its role as a safe haven asset during periods of inflation, geopolitical tension, and monetary uncertainty, offering affordability and growth potential that attract both retail and institutional investors. Ultimately, many analysts believe the recent turmoil may highlight silver's strength rather than weakness, as volatility draws attention and capital, while strong fundamentals tied to industrial demand, limited supply growth, and safe haven appeal continue to support a potentially upward long-term trajectory. Geopolitical tensions, adding fuel to metals. Beyond trading dynamics and market structure, another powerful force shaping the current silver narrative is the growing level of geopolitical uncertainty around the world. Rising global tensions, regional conflicts, and unpredictable diplomatic developments are creating an environment where investors are increasingly focused on protection rather than pure growth. Historically, periods of instability have often triggered strong movements in precious metals, and silver tends to benefit alongside gold when confidence in traditional financial systems begins to weaken. The reason is simple. During uncertain times, investors look for assets that are tangible, globally recognized, and independent of any single government or currency system. Geopolitical risk acts as a catalyst that amplifies existing market trends. When news emerges about escalating conflicts, military warnings, or deteriorating international relationships, markets react quickly because uncertainty increases volatility across currencies, equities, and commodities. In such environments, risk-off behavior becomes more common, pushing investors toward assets perceived as safe havens. Gold has traditionally been the primary beneficiary of this shift, but silver often follows closely, sometimes experiencing even more dramatic price swings due to its smaller market size and dual role as both an industrial and monetary metal. Another important aspect is the psychological effect of geopolitical instability. Even rumors or early warning signs can trigger defensive positioning among traders and institutions. Investors begin reallocating portfolios, reducing exposure to riskier assets while increasing holdings in metals that historically preserve value during crises. This behavioral pattern reinforces bullish momentum because it creates consistent buying pressure whenever uncertainty rises. The connection between global tensions and metal prices has been observed repeatedly throughout history, from economic crises to military conflicts, highlighting how deeply intertwined politics and commodities have become. Margin hikes and attempts to control volatility. As volatility in the silver market continues to intensify, exchanges have started implementing one of their most powerful tools for controlling risk: increasing margin requirements. At first glance, margin hikes may seem like a technical adjustment, but in reality, they represent a direct attempt by regulators and exchanges to influence market behavior and restore stability during periods of extreme price swings. When margin requirements increase, traders are forced to commit more capital to maintain their positions, which reduces excessive leverage and discourages highly speculative trades that can amplify volatility. In highly leveraged markets like futures trading, even small price movements can trigger large financial consequences because traders control significant exposure with relatively limited capital. This leverage can fuel rapid price acceleration in both directions, creating the kind of dramatic swings that have recently become common in silver. By raising margin levels, exchanges effectively make it more expensive to maintain risky positions, encouraging weaker hands or overly aggressive traders to reduce exposure. This process often leads to a temporary cooling effect, as speculation decreases and price movements become more measured. However, margin hikes also carry a psychological impact that extends beyond immediate financial mechanics. When exchanges repeatedly raise margin requirements, it sends a clear signal that volatility has reached uncomfortable levels and that authorities are concerned about systemic risk. Traders interpret these actions as warnings, prompting adjustments in strategies and risk management practices. Some investors may choose to exit positions entirely, while others reduce leverage to adapt to the new environment, leading to shifts in market liquidity and sentiment. Shrinking global silver supply. Another critical factor shaping the current silver narrative is the gradual tightening of global physical supply. Across major exchanges and storage facilities, reports of silver leaving vaults and declining inventories are becoming increasingly common, raising concerns about how much readily available metal actually exists for delivery. And while paper markets allow massive trading volumes through futures contracts, the physical reality tells a different story. And that gap between paper supply and physical availability is beginning to attract serious attention from analysts and investors alike. As stockpiles shrink, every withdrawal from vaults carries greater significance because it reduces the buffer that helps stabilize markets during periods of heavy demand. Physical supply constraints can amplify price movements, especially if investment demand and industrial usage continue rising simultaneously. Silver's role in solar energy, electronics manufacturing, and advanced technologies means that consumption remains strong, while mining production growth has struggled to keep pace with long-term demand trends. This tightening supply environment creates a structural foundation for potential upward pressure on prices. When physical inventories decline, the market becomes more sensitive to shocks, increasing the likelihood of volatility and strengthening the bullish narrative surrounding silver's future trajectory. Bullish outlook and long-term investment strategy. Despite the intense volatility, regulatory drama, and unpredictable price swings dominating headlines, the broader thesis surrounding silver remains strongly bullish for many long-term investors. Rather than viewing recent chaos as a warning sign, a growing number of market participants interpret these fluctuations as part of a larger structural trend that is still developing beneath the surface. Volatility, in this context, is not necessarily weakness. It can represent the early stages of a major market transition where price discovery accelerates and attention shifts toward underlying fundamentals. Many experienced investors are adopting a strategy focused on accumulation during price dips, treating corrections as opportunities rather than reasons to exit the market. This approach is rooted in the belief that silver's long-term drivers, including industrial demand growth, tightening supply conditions, and increasing geopolitical uncertainty, continue to support higher price potential over time. Instead of attempting to predict short-term movements, long-term holders emphasize consistency and patience, gradually building positions while allowing the market cycle to unfold naturally. Another key aspect of this strategy is diversification. Investors often view silver as both a growth asset and a hedge against economic instability, making it attractive during periods of uncertainty. By combining physical ownership with a disciplined investment mindset, participants aim to reduce emotional decision-making driven by daily price swings. Ultimately, The bullish outlook reflects confidence that current volatility may represent consolidation before another major upward phase, reinforcing the idea that silver's story is far from finished and that long-term positioning could benefit those willing to endure short-term turbulence. If you enjoyed this analysis, don't forget to like, subscribe, and turn on notifications for more deep insights on gold, silver, and global markets. Share your thoughts in the comments. Where do you think silver is heading next? Thanks for watching, and I'll see you in the next video.